In this week's episode of the Stock Scores Market Minutes, we'll look at how you can make money from a stock market correction. I'll do my regular weekly market analysis so we can see if a correction is coming. Then, of course, we'll look at the trade of the week on AMRS. All right, so how to profit from a stock market crash. It's actually easier to make money when the markets go down because they tend to go down very quickly. There's a saying in the stock market, the market takes the stairs up and the elevator down. That means market corrections can be very profitable, but you have to know how to profit from them. And I like to use inverse ETFs or the volatility related ETNs like VXXB or TVIX, UVXY. They're great when the market is correcting. However, they are not something that you should ever own longer term, or they are not something you should own if the trade is not working. You have to use good risk management. And that means having your stops in place, because here's the thing. Because, for example, the volatility related ETNs are based on the futures markets, there is time value decay. As long as the futures markets are in something called contango, which means that the futures months in the futures contracts, they have a higher price. And so the people that manage these ETNs have to constantly be rolling into the future months, and that causes more expense over time, and that is what causes the time value decay of the ETN. So they're great if the trade is working because they will go up very quickly if the market is correcting, but most of the time, because the market doesn't correct most of the time you have to realize that these things just lose value even if the underlying volatility index does not lose value. Now, if you want more information on that, do a Google search for time value decay of leveraged ETFs or of volatility related ETNs. There's people that have gone through the math of how that works, and it's really important to understand if you're going to trade these things. I only like to trade them in the short term. So let's just take a look at the charts of the S&P and then the volatility related ETN and the inverse ETF, the leverage inverse ETF for the S&P 500. So here you can see that the market sold off quite dramatically from October into December, and the biggest, most frightening sell-off was there in December. Okay, so keep that in mind, because now when we look at the next chart, which is of the volatility related ETN, VXXB, you can see how sharply it moved up when the stock market moved down. And so if you have a sell signal on the stock market, and in recent Market Minutes videos, I've talked about what to look for as a sign of a correction, those breaks of trend lines that we've talked about. So if you get one of those, then you want to take a look at something like this, which will go up with the volatility increase in the overall market as investors look to buy insurance against the market correction. Well, that's a big move from 32 to 50. That's how we can take advantage of a correction. But now I want you to notice what happens over here. Look at how this thing just steadily goes down as the market's going down. And it's not just because, as the market goes up. This was going down as the market was going up, which is what you expect. But it's also going down a little faster than the market because of that time value decay. Now, looking at a leveraged ETF, similar situation, except that it will actually go down even faster because these leveraged ETFs, every day they have to get balanced to reflect the triple leverage or double leverage or whatever the leverage is on that ETF. And the result is, if the trade isn't working, these things will go against you faster than the actual underlying index will go against you. It's a little bit confusing. So again, if you want to learn more, do a Google search for time value decay of leveraged ETFs, for example. Someone has taken the hour that it takes to go through the math of all that works. What I want you to understand is these are great short-term vehicles as long as the trade is working, great, but do not hold them longer term because you will lose even if the underlying index goes back to where you started. All right, let's get into this week's market analysis. And we'll start off with the US markets, looking again at the S&P 500. We had a little bit of weakness this week on Thursday, but the upward trend line is still in place, and we've talked in recent weeks about the importance of that short-term upward trend line. And of course, the longer term upward trend line is still intact. So until we break this, no cause for concern. If we break it, then we're going to probably fall to that one. And if we break that one, then we're going to fall to the one on the daily, and so on and so forth. For now, this is a bullish market, and I think it's best to be long of stocks, but watch this chart closely because these markets are running into resistance, which is what we've been talking about in recent weeks as well. We've had this great rally off of the lows, and now we're coming up to resistance, and you can already see that the buyers are hesitating a little bit at that resistance level. This past week, we couldn't hold the gains that we made when we gapped up on, I think it was Wednesday. Sorry, the gap up was on Wednesday, and the market looked really healthy at the open, and then it just sold off from there and continued lower through the day. All right, so continuing on with the Russell 2000, which is the US small cap stocks, and it's in this pattern of sideways trading. We do have optimism because there's rising bottoms, but until we can break out through this level, not going to be a lot of action in those small caps. And we did have a bit of a breakdown in the biotech sector this past week, and that has got a heavy weighting in these small cap stocks. A lot of those small cap biotech stocks are in this index, and that's certainly hurting a little bit as we see some money coming out of those biotech stocks. All right, on to the Canadian market. And here is the TSX 60 with a resurgence in oil prices, and now we're getting some follow through in the Canadian energy stocks. It helps that governments have changed in Alberta, and perhaps that will help those Canadian energy stocks continue to move higher. And that's really what's pulling the Toronto Stock Exchange up. Because not only is it the energy stocks, but it's all the industries around the energy sector that are also doing better. And so we have a nice bullish trend here, getting a little long in the tooth. And however, with that said, we did break through long-term resistance on the TSX this past week. We actually did it the week prior, but it wasn't a decisive break. We've made that decisive break. Now, this is my concern about this. I don't like it when markets break through resistance without at least going sideways first, because the tendency then is after they break out, they usually pull back a bit. And so I think that the Canadian market is really due for a pullback. There is no sign of one, and therefore you have to stick with the trend. But if you see this trend line break, then you want to maybe think about taking some profits on some of those strong moves that we've had in certain sectors of the TSX. Looking at the TSX Venture, which has a heavy weighting in cannabis stocks, the cannabis sector getting a little bit of selling pressure in the last little while, and I think that's why we have broken that cycle of rising bottoms, and that is a concern. I think we could see more weakness in the cannabis sector and perhaps taking us down to these levels, and so I exercise some caution with that micro cap and small cap group in Canada. On to currencies. US dollar broke out to some new local highs for the year right there from optimism, and I think the US dollar looks more likely to go higher than lower, perhaps only stalling when it gets up to long-term resistance there. Canadian dollar, because of that strength in the US dollar, it is unable to break its downward trend line. It's interesting because usually the Canadian dollar is very correlated to the price of oil, but it's not able to battle back despite the strength in oil. And I think that's a bit of a concern. Now we have formed a rising bottom, and so if we can break that downward trend line, then I will switch my view, but for now I am bearish on the Canadian dollar. On to interest rates, we look at the bond market to give us an inverse correlation to interest rates, and you can see the bond market broke out. It's pulled back for the last 3 weeks, and it probably is going to bounce. The fact that we closed, this little candle here is called a doji. The fact that we closed more or less on the open after a couple of sell-off weeks means the bond market likely to move higher in the near term, and that would mean interest rates moving lower in the near term. But let's wait to see if we can break that cycle, that downward, what we call a flag pattern. If that happens, look for the bond market to move higher. Finally, commodities. We'll look first at gold. And gold, because of the strength in the US dollar, has now broken down through support from a falling top. I think gold is destined to go lower. Probably next stop in the next week or two down to 118 on the GLD. And so I would advise caution with gold stocks. There you see the oil market continues to be in an upward trend, stalling a little bit there, and that perhaps showing that the buyers are a bit tired and perhaps will pull back near term, but no sign of a pullback until we get a break of that upward trend line. I would stay bullish, but somewhat cautious with oil. And finally, the fear chart, VXXB. This is the thing that you only want to trade when the market's correcting. You know, you'll sometimes get these little blips, and then it ends up not working into a correction, and that's where you got to take your loss and move on. Same thing here, take your loss and move on so that you avoid that time value decay as the market stabilizes and volatility compresses. Right now, volatility very low, and that implies a little bit of complacency among buyers. That's usually what happens right before a correction, but there's no sign of that yet. Wait for the sign that money is moving into the volatility indexes and moving out of the stock market. So my ratings then, neutral US stocks as we come into resistance, but still in a bullish short-term trend. Canadian stocks bullish on both time frames. We have broken out to new highs. I'm worried that we'll see a pullback before we go higher. Gold bearish on both time frames, and oil bullish on both time frames. US stocks are drifting upwards toward a strong wall of resistance, and that's driven more by a lack of motivated sellers than it is really strong buying. Canadian stocks are at an all-time high as the energy market recovers. Oil is in that strong upward trend that should be watched for a trend line break, so keep an eye on that. Gold has broken down through support this week, which means I think it's more likely to go lower than higher, and fear is low. All right, let's take a look at the trade of the week. And this is AMRS, which was a trade on Thursday. Of course, it is a shortened week for the Good Friday holiday. And AMRS triggered an action candle at the open at 9:32, met all of my criteria for an alpha stock. And if we look at the economics of it, if you wanted to take $100 of risk on that trade, it required a position of 580 shares. 580 shares times the price of 442 is 2,563. However, you can leverage that 3-to-1, meaning that your capital required is $850, and it ultimately closed at 3.65 RR. So take 3.65, multiply it by 100, and you get your $365 gain for every $850 put to work. And that's a 43% return for a one-day hold. Those are the kind of trades I love. Very high return for the capital required, and not a lot of capital required. You can take $100 of risk in this stock for $850. Some trades take $30,000 to take the same amount of risk. So these lower price stocks are the ones that tend to give you the best bang for your buck. But you have to practice good risk management because they are also much more volatile. Well, that has been the Stock Scorers Market Minutes for April 22nd. I hope that you have a good holiday weekend for Easter and a great week in the market next week. Please subscribe to the channel, hit the like button, leave a comment if you have one. Most importantly, trade well.